In exercise 2.1, we are given some information on investment alternatives. And the first piece of information is that the yearly cost of capital rate is 8%. That's the same as the discount rate, that's 8%. And alternative 1 is an investment of 120,000 to be used for 5 years with scrap value of 8,000 kroners and yearly earnings of 33,000 kroners. Now, the easiest way to do this exercise is to choose investment under useful tools and then just type in the information given. This is an annuity, so the payments are equal for each term, each period, so therefore we choose that Excel sheet. Now the outflow in year 0, that's 120,000. The yearly inflow, that's 33,000. The number of years for the investment, that's 5. The scrap value, in this case, that's 8,000. Now the results that we are given show a net present value of 17,204 and an internal rate of return of 13.14%. And that's actually what we should answer in this case. Now we should probably show some calculations in this respect. So first we copy this into our document. And we could, in this case, just write the function for net present value. As we can see from the Excel sheet, it is given by the interest, the number of periods, the yearly inflow, and the future value. So what we type in is 8%, and then 5 years, 33,000 and 8,000. The net present value of all these payments are 137,204. The outflow in year 0 is 120,000, and the net present value is then given by this number. So that's the first calculation. The next calculation, that's the internal rate of return. And we just copy that. And then we can insert that in very much the same way. And again, it's a good idea just to show the calculation. In this case, we use the formula, internal rate of return, and we are given the number of periods, the inflow, the outflow in year 0, and the future value. So the number of periods, that's 5. The yearly inflow, that's 33,000. The outflow in year 0, that's minus 120,000, and the future value, that's 8,000, and that's 13.14%. Now next we should decide whether this investment is profitable, and we can write that the investment is profitable because NPV is positive and because the internal rate of return is larger than the discount rate of And for the sake of consistency, we color it all red. And that's actually what we should do in that exercise. Next, we are given information on a new alternative, alternative 2. It's an investment of 200,000 and it can be used for 5 years with a scrap value of 14,000 kroners. At the end of period 2, however, the investment require a further investment of 60,000 in extra stock management software and new shelves. And at that point in time, we will sell the old shelves to at their booked value of 20,000, and we get some information down here as well. What we have to be aware of is that it's not an annuity investment anymore. From this calculation down here, we can see that the net increase in contribution margin from this information will be 60 for each year, because the net increase in turnover, that's 60. Then we have an increase in material cost, but that is equaled out by a decrease in wages, meaning that these two effects will cancel each other out. So the net increase in contribution margin is 60. Of course, that looks like an annuity, but we have forgotten that at the end of period 2 we have to make this further investment of 60,000, and we get extra 20,000 from selling the old shelves. So what we should do is to open this sheet and then go for not equal payments. Up here the discount rate is 8%, number of years 5, the scrap value that was 14,000. The outflow in year 0, that's minus 200,000. The inflow in year 1, that will be 60,000. And at the end of year 2, we have to remember that we have to invest a further 60,000. However, we will get 20,000 back. So that's extra cost related to this. So the net inflow in year 2, that will actually just be 20,000. And I can write the calculation for that out here. We get 60,000 from increase in turnover. Then we have to invest extra money of 60,000, but then we get 20,000 from selling the old shelves. Now for the remainder of this investment, we get 60,000 per year, like that, for each of these years. And down here we have to remember to include the scrap value. So that's 74,000 that we get at the end of year 5. So now we should be able to read the net present value and the internal rate of return from this investment. And we can read it here. And again, it's exactly the same. We copy this into our paper. And this calculation is simply given by all these information. And if we should write a small calculation of that, we can write equals NPV and then 8%, and then just cash flow. We don't have to show it all, but just write that we have entered the cash flow afterwards. The net present value, that's 14,000. Now we do the same with the internal rate of return. We can find that down here, and we simply copy it and paste it. And in this case we can also write a small calculation, and as we can see, all that we have to do is to insert the cash flow. So we write of cash flow, and then in this case we always have to make a guess. So in this case it was just 3, so it doesn't matter. Now all of this we color red once more to show that this is the result, and then that's the internal rate of return. Next we should decide which of these two investment options that is the most profitable, and in this case it will be the investment alternative 1, simply because it has a higher net present value, and that's what we have to go by. So we write investment alternative 1 is the most profitable as it has the highest net present value. And we don't actually have to write much more than that. That's sufficient. That's always the rule when we have to choose between two. Next, we are told to calculate the capital service, meaning the costs for depreciation interest for the new 200,000 Kettle 6B, and then explain the result. Now let's look at this sheet. It shows that the capital service will be 47,705. We'll just copy that. And then we should explain the result. Now the capital service, is equal to the yearly costs on depreciation and interest. It is therefore also equal to the minimum yearly net inflow for the investment to still be profitable. Meaning that we need a net inflow of equivalent 47,705 for this investment to be profitable. In this case, well, it is profitable, just not as profitable as alternative 1. So we color it red, and then that's the end of that exercise.